So I've been looking into Nintendo as a research project, and I have to show this because it's so crazy. So this is the FY26 compensation for Nintendo executives, and Furukawa is the president, he's basically the CEO. So his fixed compensation in US dollars was basically 500,000 a year. So pretty modest, I would say, for a 40 to 60 billion dollar company. Performance-based compensation was 1.35 million, and then his RSUs were like 150K. So over the whole year, he earned $2 million. The CEO of Nintendo earned $2 million. How is that possible? What is going on here? If this was a US company, this guy would be making like 40 million a year. He'd be making at least 10 times this. So it just goes to show the difference in corporate culture between these companies and why when you're analyzing a business, there's so many assumptions that you just can't make. So what I want to do in this video is go through my research on Nintendo and look at who Furukawa is, his background and his history, what type of sort of CEO he is. We'll look into his compensation and his alignment and like how much of the company he owns, as well as, since he's been there for 8 or 9 years now, we'll look at his capital allocation decisions and make a judgment on his performance and his competency to date. So let's just jump into it. So Furukawa is in his 50s now, but when he became CEO, he was actually pretty young. He was in his 40s, becoming CEO of a century-old company, which is pretty impressive. And he had been at the company since 1994, joining as a junior accountant and then making his way up. And he's worked all over the world. He's worked in Nintendo of Europe. He's worked at the Pokemon company. So he's had this long upward trajectory into the position. And when he became CEO, it was at a really important time in the business because he became the president in 2018. So that was basically a year after the launch of the Switch 1 and the period after the disaster that had been the Wii U for Nintendo. So it was a period of a lot of uncertainty for the company. And I would say it was a pretty large placement of faith that the company put in him when they made him president at such a young age. And the plus side of that, which I've been thinking a lot more about, is that him being young or relatively young in his 50s means that if he and the company want, they have a long runway in front of them in terms of his tenure. I think a lot of businesses right now are going through this weird phase where the CEOs who have been in charge of the business for quite a while are retiring. And that brings a lot of uncertainty to the business and therefore the investment. And to have a CEO who's young sort of strips a lot of that risk back, in my opinion. Judging his tenure, I think it would be hard to say that he hasn't done a great job. Revenue has basically doubled if we just take FY26 versus FY18. Now, there are some caveats there. FY26 is a console launch year with the Switch 2, so it would be expected that revenues are going to be a lot higher in that year. But at the same time, just looking at some of the other years, this is a very clean console cycle. It's pretty much exactly what you would expect for a business like Nintendo. And then the transition to the Switch 2 also executed pretty much flawlessly. The Switch 2 was the fastest selling console in Nintendo's history. On the operating income side, it more or less follows, again, exactly what you would expect. The drop-off is expected because of the nature of the console cycle, and consumers hold off on buying a console or buying accessories for their old console or games, etc., because they know the new one is coming out. This is all expected. The reason operating income is low in this year is because hardware is a higher mix of their total sales amount, and that has a lower margin. So again, that's expected, and you would hope that the Switch 2 is essentially able to just build on this and have a very similar hardware arc. I'm not sure if that's going to happen. We will get to that when we value the business in the next video. But otherwise, I think we can move on here. So the next thing that I want to talk about is their guidance accuracy. So what I did was I went back through every single annual financial statement and put together these charts. Now, one thing I'll say is that they update their guidance every 6 months. So it's not a perfectly fair comparison, but ultimately I want to look at what do they forecast at the beginning of the year and how does it generally turn out. So if we look at the last couple of years in terms of their sales, they're typically pretty good, to be honest. They missed really hard in FY21, but that is because of COVID, and they forecasted very conservatively. So I think we can cut them a little bit of slack. That would have been a very difficult year to forecast, and they went conservative, and it ended up being great that people are stuck at home, they buy games. And then the other big miss is in FY26. Again, that's a tough year to forecast because it's a launch year for their new console, and you just don't know how it's going to turn out. There's so many variables that are hard to predict. How well is your marketing going to land? How is it going to work in different regions and geographies? How were smaller geographies that Nintendo didn't launch the Switch 1 into, but released the Switch 1 later in the cycle, going to react in a console launch year? There's some things around it. That said, I'm going to leave that one in. I think COVID is the one where you can give them the full benefit of the doubt, and the rest we can include in our judgment. So with COVID excluded, we're looking at an 8.8% miss on the absolute value of the difference either year. We're not looking at their positive and negative trends. They clearly generally forecast conservatively, but just on the magnitude of the miss, whether they miss positively or negatively, it's about 8.8%. Looking at the operating profit, it's a similar story, but quite a lot more magnitude in their miss. And that kind of makes sense. If you're thinking about sales, you're thinking about how much you're going to sell. When you're thinking about operating profit, you're taking that into account, but you also have to forecast your costs. Are suppliers going to raise prices? What is your bonus payments going to be? Benefits that you pay out to your employees? All the costs that go into your P&L. It is a bigger miss when we exclude COVID. We get an 18% average miss on their guidance, and that's quite useful to know going into a valuation. The other thing that Nintendo provides guidance on is their hardware and their software. So looking at the hardware, it's quite a bit of a more mixed story. They tend to miss by about 15%, but it's different in terms of them consistently forecasting conservatively. We can see in FY22 and FY23, they missed on hardware in the negative direction, but then in FY26, in that launch year, they over-delivered. So a little bit of a mixed story there. And when it comes to software, it's very similar to hardware, although I would say they have been a lot closer in recent years. That might be because they were holding back on hyped releases because of the launch of the Switch 2. So they're forecasting the sales of games that they already have a sense of how much it's going to sell versus them releasing a brand new Mario game, for example, which who knows how that's going to go. Overall, I think what we can take from this is that this is a hard business to forecast because of the nature of the console cycle. And I'll tell you right now, I'm going to do the valuation in our next video, but I found it really hard to forecast and value this business as well. It's just such a long period of time where results swing with quite a lot of volatility, and that makes it really difficult to predict what exactly a number is going to be in any given year. So that said, Furukawa has been in charge now for 8 or 9 years, and that gives us a nice range of time that we can look back over his capital allocation decisions over that period and assess whether or not they were intelligent, and we can put faith in him going forward. So I've built this chart here, and it's a little bit of a weird chart. So I'll explain it first, and then we'll talk about what it tells us. The first thing is the line chart here that I want you to understand. This is cash generated, which is not a accounting term. I kind of made it up, but it's basically operating cash flows from any given year of the business, and then adding back research and development expense. And the reason I did that is because for a lot of businesses, you'll look at their CapEx to understand how much they're reinvesting in the business. But Nintendo, being mostly a software business, doesn't have high CapEx requirements in order to continue to grow and to operate. What they do have to do is commit a lot of money into R&D, into developing games and a new console. So I wanted to be able to capture that as a form of reinvestment into this chart. And just to touch on a little bit of the basics of accounting is that an expense on the income statement is not necessarily cash outflow. Expenses get recorded in the period that the expense is incurred, not when the cash is paid. So for example, let's say you pay $120 a year for a software subscription and you pay at the beginning of the year. The $120 doesn't flow to the income statement in January. You recognize $10 every month, even though the cash went out in January. So if you have a multi-year contract, it works the same way. That said, I think a lot of their R&D is probably salary expenses and maybe some hardware components that they're playing around with. I imagine it's mostly cash expenses. So I think it's okay to add it back in. I just wanted to give that caveat to this chart. So the bar charts are their total capital outlay. The gray boxes are buybacks, the black are dividends, the little pink one is capex. That's why it's so small. They don't have a lot of capex. And then the red is that R&D that we just talked about. So the difference between the cash generated and the top of the bar chart would be cash retained and kept in their bank account, essentially. And in years where it goes below, it means that they didn't save any cash that year. They were in the negative in that year. So when we look across the whole period and we group R&D and CapEx together into a reinvestment bucket, and then dividends and buybacks together into a returned to shareholder bucket, we can see over the last 9 years that they have reinvested about 30% of the cash that they've generated through the business back into the business in order to maintain and grow. They've returned about 49% of their cash generated back to their shareholders, and then they've retained about 21%. Couple things this tells us, I think, right off the bat. Nintendo is not a true compounder in the Warren Buffett sense of the word. It's not a business that can just reinvest all its free cash flow back into the business and grow at the same rate that it was before. Even though Nintendo has a great return on invested capital, they don't have somewhere that they can invest all that money. They're kind of what Warren Buffett would call a cash cow. And that's why they've returned so much money back to the shareholders over the last couple years. One question that we've talked about a little bit in the prior period is why they're keeping so much cash. And I'm not gonna rehash the whole argument that I made before, but at the end of FY26, they had 1.5 trillion yen on their balance sheet. And I don't know what it is off the top of my head, but that's something like 8 to 10 billion in cash that they have just in their bank account, earning the low interest rate of Japan, which is below 1. It's actually been like 0. So that is a pretty valid criticism that someone could have of management. Now, I think I added a little bit of nuance to say that they tend to keep a specific amount of years of operating expenses in that bank account in case something goes wrong with a console launch. But again, it's a very valid criticism to say that they have too much cash. The next question I think we need to answer is this dividends and buybacks question. Before we get into it, the basic way that you would want management to allocate capital is that if the business can earn a high return on that capital, they should reinvest it, all of it. If they don't feel that they can earn a great return on that capital, they should not invest it. They should return it to shareholders. And they have 2 options for that: dividends or buybacks. Buying back their stock has a couple key benefits, one of which being that it's more tax efficient. So the company pays tax on their income in the year, and then if they pay you dividends, you also pay tax on that dividends. So there's a double taxation there. Whereas if they buy back their shares, that doesn't occur. It's just taxed once. So it's a little bit more efficient, but it's only a good use of capital if the shares are undervalued at the time. Because if they're overvalued, then the shares that they're buying, like you and I investing in it, might drop in the future, and then therefore you're destroying value. So if the shares are overvalued, they should return the capital to their shareholders via dividends. That's the basic theory. And I want to understand why they felt that allocating this capital back to the shareholders was a good idea, and whether or not the years that they performed these buybacks was a good time to perform those buybacks. So let's take a look at this chart. So this is just the Nintendo stock price, and then each line that I've added here was roughly when they performed that buyback. And I think what you can see is that they performed these buybacks at pretty opportune times. These were low points in the console cycle, and they were able to buy those shares back at presumably below the fair value of the company. This buyback here, though, I would just note something for you, is that it was not a traditional buyback in terms of them saying, oh, our shares are undervalued, we're gonna buy back those stock. What has been happening for the last decade or so in Japan are these corporate reforms in order to improve governance of businesses across Japan. There is sort of a pattern of poor governance in a lot of Japanese businesses, and the Tokyo Stock Exchange has been putting pressure on businesses to improve it. And part of that is to reduce the level of cross shareholdings that a lot of these businesses have. So what you'll see is that a lot of businesses in Japan own shares in each other. And that's not really an ideal thing because it's just a form of like circular financing, which kind of increases risk and inflates the earnings and values of those businesses. I won't get into the detail on that, but you can see in this notice to shareholders that basically what happened was that all these banks got rid of their shares in Nintendo, and Nintendo bought them back and then canceled them so that they're not outstanding anymore. One other thing I want to point out on this chart is the rise in R&D that's been happening. I think that's a combination of just general game development costs increasing as graphical complexity increases, the cost of people increases, and just general size of games grow. And I think we should expect that trend to continue. One, because I don't think those reasons are going away. But two, if you dig into Nintendo's facilities and equipment that they're building out and you read the names of these, most of these are facilities that I think would be contributing to R&D in the future. So this one is just straight up research and development facilities. But then you also have production facilities for molds and stuff. So if they're casting the size of a console, I think that would go into R&D as they're building out that console. They have a technology development center. No clue what that means, but that's probably also an R&D facility. And then the rest is just renovating and updating buildings. But most of these and the majority of the planned investment amounts is definitely going to be used for R&D in the future. Okay, and then finally, I think is probably the most important part of this video is we're going to look at the alignment between leadership and shareholders, because at the end of the day, you want to be on the same page as management. And if you're not, you can't really have trust that they're just doing what's in your best interest. It needs to be in both of our best interest. So like we touched on at the beginning of the video, Furukawa and, for the record, the rest of the directors make so little money in their general year-over-year compensation. And I think that's good. I think Warren Buffett famously takes a $100,000 a year salary because he has most of his wealth in Berkshire. So that is kind of what you want. You want your executive team to say, we don't need to be compensated a lot. We're going to perform well, and that's going to be enough reward because we own the business. The problem with that is that Furukawa doesn't own a lot of the business. He owns 18,000 shares in the company on a company that has 1.3 billion shares outstanding. That means he owns 0.001% of the business. And the stock has been pretty volatile recently. The recent low was 6,800 yen, and it's currently at 8,900 yen. So if we do the quick math and we give it a share price of 6,000 or 9,000, and then we translate that into US dollars, we're getting a value of almost 700,000 to $1 million. So he owns at best $1 million worth of Nintendo. And he made $2 million this year in essentially his salary. This is so weird. It's such a weird structure of allocation. And to be honest, part of it is remarkable because Nintendo is so conservatively managed and they've shown such discipline in M&A and being long-term focused. But what that tells you is that what's happening is that they have a strong management culture, but the incentives aren't there. And look, they've maintained that strong management culture for decades, and I'm not going to knock them for that. But it's not going to help me sleep at night to know that the leader of the business doesn't have the same incentives as me as a shareholder. And I think that's really important to keep in mind because at the end of the day, a stock's price chart is not just going to be up and to the right. And at least if you have faith and trust in the management and you know that your incentives are aligned and you guys are together in the struggle, you have that, and that might help you hold on. So that's my analysis on management. The next video is maybe the most exciting one. That's where we're actually going to take everything we've learned to date and put a value on the business. So make sure you subscribe to watch that. And otherwise, thank you for watching.